Welcome back, everyone. Today we're diving into something wild, a fascinating look at the hidden, incredibly high-stakes economics of global infrastructure. We're going to explore a business model that, on the surface at least, looks like the most perfect cash machine ever invented. But underneath, well, it's fraught with mind-boggling risks. This explainer is all about the crazy business of owning an airport. And it brings up a really serious question. How do the smartest infrastructure investors on the planet, people with literally hundreds of billions of dollars to deploy, manage to lose spectacular amounts of money on the ultimate toll booth investment? I mean, this is an investment that by every reasonable measure should be a guaranteed, absolutely slam dunk win.
Section 1. The Ultimate Monopoly Dream.
Okay, let's dive into this incredibly seductive fantasy that draws investors in. The dream of owning an airport is pretty straightforward. As the saying goes, an airport is essentially a modern toll booth. You buy some land, pour a runway, let the planes land, and just collect the fees. There's one road in, one road out, and every single traveler who uses it has absolutely no choice but to pay you. Nobody's gonna just build a competing airport right next door, right? You are, by definition, the only option. It is a permanent monopoly. Now, for most of history, governments owned these monopolies. But in the 1980s, this massive wave of privatization kicked off. Think about this. In Europe today, 76% of passenger traffic moves through privately owned airports. In Latin America, it's 78%. Investors typically snatch these up through massive 40 to 99-year concessions. But the United States is a massive anomaly here. With the exception of San Juan, Puerto Rico, major U.S. hubs like JFK and LAX are publicly owned. They're funded through tax-exempt government bonds that private buyers can't easily access, which makes the whole privatization game in America unusually difficult.
Section 2. The billion-dollar price tag.
So these massive assets are up for grabs in most of the world, but the reality of actually acquiring one? It's staggering. To put the sheer scale into perspective, in 2022, a consortium of Australian superannuation funds bought full control of Sydney Airport. The price tag for that single airport was roughly 32 billion Australian dollars. It was the largest infrastructure takeover in Australian history. And the crazy part? The buyers actually considered this a highly reasonable price. Why on earth is $32 billion considered reasonable? Well, it all comes down to EBITDA, basically a fancy term for the money a business earns before paying interest, taxes, and a bunch of accounting adjustments. A healthy airport usually sells for a massive 15 to 23 times its annual EBITDA. Keep in mind, that Sydney deal happened right in the middle of a pandemic when travel had completely collapsed. These investors weren't buying today's earnings. They were paying a huge premium to lock in a permanent geographic monopoly for decades and decades of expected future travel. But what if you can't buy an existing airport and you have to build one from scratch? The upfront capital you need before a single plane even lands is just mind-blowing. Building just one single new runway at Heathrow is estimated to cost anywhere between $13 and $18 billion. Brand new airports like Beijing Daxing and Istanbul, they cost $17 billion and $12 billion respectively. And that's just for the first phase. You aren't just paving a road here. You're literally building a small city, complete with miles of underground baggage networks, enormous security systems, and massive backup power grids that have to run 24/7. And this brilliantly illustrates the absolute deadliest trap in airport economics: construction delays. Because you always have to borrow money to build an airport, you start paying interest the day the loan arrives, not the day you open for business. Take the Berlin-Brandenburg Airport, for example. It was supposed to open in 2011 for 2 billion euros. It didn't actually open until 2020, costing 7 billion euros. That is 9 straight years of paying interest on billions of dollars while generating exactly zero revenue. So what caused a 9-year delay? It wasn't natural disasters or anything like that. It was a cascade of seemingly minor, almost absurd failures. The smoke extraction system kept failing its tests. Cables were laid without documentation, which meant perfectly good work had to be torn out just so it could be inspected. I mean, even the escalators were the wrong size. Together, these ridiculous errors cost an extra 4 billion euros. It perfectly mirrors Denver International Airport back in the 90s, where a faulty baggage system that literally ate people's luggage delayed the opening by 16 months. That cost Denver an estimated $1.1 million in interest every single day it sat empty.
Section 3. The real moneymaker. Now, acquiring and building these megastructures is financially terrifying. But once the doors finally open, How do airports actually print money? Well, the income is split into two completely different worlds. First, you have aeronautical revenue. This is what you charge the airlines to land their planes and use the runways. Sounds great, right? But it's highly regulated. Because airports are monopolies, governments put very strict caps on what you can charge. It's never as much as the airport actually wants. But the second category, non-aeronautical revenue, now that is an unregulated goldmine. This is literally everything that happens inside the terminal.
Now, what's really interesting about the global revenue breakdown is the sheer volume of that stealthy second business. Globally, nearly 40% of all airport income comes from non-aeronautical sources, and in Europe and Asia, it's often way higher. This business operates entirely separate from aviation. It isn't capped by regulators, and honestly, it grows much faster than passenger numbers do. We've all grimaced at paying a massive parking fee at an airport, right? Well, this completely explains why. The single biggest source of this unregulated money, especially in the US, is parking. Because airports hold a complete geographic monopoly on the land around them, they can basically charge whatever the market will bear. Premium covered parking routinely hits $100 a day. In 2024, Dallas-Fort Worth pulled in $251 million from parking alone. LAX made $181 million. It acts as a multi-$100 million unregulated cash machine. And once you step inside the terminal, every single inch of the architecture is weaponized to make you spend. It's brilliant behavioral design. Right after the high-stress security checkpoint, designers hit you with what they call a recomposure zone. It's got lower ceilings and softer lighting to signal your brain that it's safe to relax, which to them means it's safe to spend money. Then comes the forced duty-free walkthrough, which studies show boosts sales by up to 60%. And here is my absolute favorite detail. Because most people are right-handed and pull luggage with their right hand, they naturally look to the right, so modern airport walkways actually curve to the left, forcing passengers to continuously face high-margin merchandise on their right side. I mean, it's just fascinating. Section 4. Surviving the fixed costs. But, of course, all this incredible retail revenue comes with a major catch. The terrifying reality keeping infrastructure investors awake at night is relentless fixed operating expenses. When the government mandates a brand new 3D X-ray security standard, you have to buy the machines. There's no negotiating. You have to run miles of underground baggage conveyors constantly. You must staff full emergency fire crews, even at 3 a.m. for a single random cargo flight. And you have to keep million-dollar snowplows on standby at a moment's notice. These massive fixed costs literally never sleep, completely regardless of whether 20 million or 10 million passengers walk through the doors. And in early 2020, we saw exactly what happens to a business with enormous fixed costs when variable revenue suddenly disappears. Total industry passenger revenues completely collapsed by $418 billion. That's a catastrophic 69% drop. But the airports couldn't just shut off the lights or fire the security teams. The fixed costs stayed entirely intact. To survive, airports had to adapt drastically. They paused the minimum revenue guarantees their retailers owed them just to prevent mass bankruptcies, and they rapidly converted empty passenger terminals into cargo hubs just to keep a tiny trickle of revenue alive. Section 5. Mega hubs versus ghost airports. This brings us to a really stark contrast in the industry, the difference between spectacular failures and hyper-profitable mega hubs. On one end of the spectrum, we have the ghost airports. Take Ciudad Real in Spain. It was built for 1 billion euros to capture Madrid's overflow, but airlines simply refused to fly to a small town 200 kilometers away from the actual market. It went bankrupt, sold for just 56 million euros, and basically became an aircraft storage lot. Or look at Matla Rajapaksa in Sri Lanka. Built for $29 million. Today it sees roughly a dozen passengers a day and literally rents out space to store rice. These are embarrassing monuments built on political ambition rather than actual airline route data. If the airlines won't come, the passengers can't come, and you're left with a billion-dollar empty building. So the crucial point is this: when an airport actually works at scale, the profits are staggering. Take Spain's INA Group. They manage 46 airports and handled nearly 369 million passengers last year. They reported an operating margin of 60%. In most industries, a 10% margin is considered super healthy. At 60%, an airport is extracting extraordinary value from every single person who walks through the door, and it's largely driven by that uncapped retail and parking revenue. And the most profitable mega hubs, they are evolving fast. The future is the Aerotropolis model, where entirely new commercial cities, logistics parks, hotels, research labs are built right around the terminal, generating massive real estate income. Inside, airports are aggressively rolling out biometric facial recognition to completely eliminate security queues. Why? Because every single minute you spend waiting in a security line is a minute you aren't spending money. Frictionless travel means maximum retail dwell time. It's a brilliant, if slightly scary, economic truth.
Ultimately, owning a major airport is about securing a permanent piece of infrastructure that forces every airline to pay you, forces every traveler to walk past your shops, and forces every driver to park in your lots. It really is one of the most durable positions in global business. But it leaves us with one final, provocative question. You might hold the keys to this ultimate toll booth, but can you survive those crushing fixed costs long enough to collect the fortune waiting inside? Thanks so much for joining me on this explainer. I'll see you all next time.